Good afternoon, everyone, and welcome to another one of Avant-Garde Trading's free educational webinars. Thank you for joining us today, and we are happy to host our guest presenter, Keith Harwood. He is with us today to speak to you all about the do's and don'ts of investing in a down market. Keith, are you with us?
I believe so. Thank you again for hosting me, Natalie.
Oh, my pleasure. Thank you so much for taking the time to put the presentation together and join us. I know you've got a busy schedule, just like everybody here. Thank you to the attendees who are here with us live, who took time out of their days to join us as well. Keith, you can go ahead and pull up your presentation when you are ready. And while you're doing that, I'll remind everyone here who is live in the Zoom room, if you have questions, you can go ahead and type those questions into the chat box. And I'll get those over to Keith to answer at the end of his presentation, time permitting. Keith, I can see your presentation. Looks great. So whenever you are ready, feel free to get started.
Absolutely. Thank you again. And thank you for everybody that's here live. I really appreciate you guys taking your time out, as Natalie mentioned before. So today I wanted to talk about some of the do's and don'ts of investing in a down market. It seems obvious when you've got a down market that people get a little bit psychologically involved and emotionally invested in the market. Before we get into the actual conversation for today, though, I always start with some disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Again, if you have any other questions about the disclosures, please go ahead and reach out to me or take a look here. And remember that Option Hotline is not an investment advisor, not registered with the SEC or FINRA. So if you do have questions about your own personal financial situation, I recommend you reach out to your registered financial advisor. All right. So with that in mind, a little introduction to myself. I started my career in the option pits of the CBOE as an options market maker. So back in 2005, graduated from Notre Dame with a degree in math and economics and went naturally to go into the financial markets. So options are a very complicated tool for trading the markets, and the mathematical background that I've got, more of a statistical analysis basis, really helped me to leverage my personal skill set with the leveraged toolkit that the market provides in options. I transitioned to off-floor trading and started constructing directional portfolios using options and futures as a market maker, proprietary trader, and a hedge fund trader after I got my MBA. All right. After I worked through that for a number of years, I decided to go to the educational side to help more traders in trying to figure out ways to express their market view intelligently using all of the tools that we've got available in the market, such as options, futures, and equity. That's why I started with Option Hotline, gosh, I guess 7 years ago now, as the chief options strategist in 2018 to share my expertise in options, equities, fixed income, and commodity trading. And where are we at today in the market? Before that, if you do have to leave early, you can always email me, keith@optionhotline.com, or call me 312-600-8004. Always available during market hours. And if I don't see your call, I will certainly call you back. Or ping me with an email if you have questions that come up after the presentation today. You should also keep an eye out for support@optionhotline.com for a free giveaway. That'll be coming to your inbox after the webinar today. I believe that should show up there tomorrow. So keep an eye out. It may hit your spam folder, and it's free. So why not grab your free giveaways? So what are we going to talk about today? Well, the market turmoil. We've had a month of down move. We had a 10% pullback in the S&P 500. And I think the natural question on people's minds is this over? And if it's over, am I ready to buy? And if I'm ready to buy, what happens if it goes lower? And how do I want to take advantage of this opportunity or avoid the downfalls of jumping in too early? And that's what naturally leads us into the bottoming process, where the market starts to show us signs that the bottom is more likely to be in than not. So nothing's ever a guarantee, but what we're looking for is those higher probability scenarios where the bottom is more likely done for now. We may have further downside coming afterwards. We may have further upside, but everything that we do with a technical basis is based upon when that liquidation, when that risk reduction element of the market has reached its ultimate end and the market upward trend that naturally occurs over time because of investment flow from things like 401k investments that are long-term holdings and big money managers starts going back into the market. I'll obviously get into why I use options, because everything I do, I use options. Options are a really powerful tool, but they can be a dangerous tool if you use them incorrectly. So I want to talk through why options and how to make sure that you don't fall into some of the pitfalls that can turn a small loss into a large loss, but it can also turn a small gain into a big gain. Along with that, we want to understand how Vega impacts investing with options, because right now, if you guys have been watching, they've talked about the VIX a lot. The VIX is a illustration of how much risk there is in the market and how much fear there is in the market, and that will impact the way that I can invest with options, particularly as I look at longer term options that have now gotten priced higher because of that fear in the market. Options market signals of a bottom are certainly another key element for me when I'm looking through that bottoming process. So I've got the technical element to start and some of the option market signals that I look for near the end here before we get into the trading signals and how I traditionally look to invest in options or invest in the market utilizing options. So without further ado, what's causing our market turmoil? Well, we got a couple of things. We got tariffs, of course. We had an upward trending market. Everything looks great. And then this big bear named tariffs comes charging in and derails it all and makes people go to the fear mode, puts people to the sidelines, gets people nervous about what the long-term health of our economy is. And we've started talking through that. Is the US economy headed towards a recession? That's the Washington Post headline. AP, a rolling recession or a recession might spare the US economy from a full-scale downturn. Where does this land? Do we have kind of a soft landing and then a recovery? Can the Fed intervene? Can policy intervene? How do we come out of this? And is recession really going to happen now? Or is this more of a buyable dip opportunity like we've seen for the last, 17 years now? When was our last major real recession? The subprime crisis, maybe some of the COVID liquidation. But we don't have a real big recession to me since the subprime crisis. That was back when I was just getting started really in the options pits. It was a wild time. The VIX was trading up at like 90. Now, when we see the VIX at 30, we start to freak out. So these are very extreme, volatile conditions for recent history, but for the long term, this isn't necessarily indicative of a major recession yet. We'll continue to watch the data and see if that shifts, of course, and if we have the tools to pull ourselves out of it. So as we go through this bottoming process for the market, we tend to follow a few main patterns on a technical basis to show when that bottom is in, to show that we're not going full-blown economic recession with market liquidation, risk off, fear, everything else hitting the market for months at a time. First off, we look for those extreme oversold conditions. RSI is a relative strength index. I'll show you what it looks like on a chart, on the next chart. But generally speaking, the signal that I'm looking for from a technical basis is called the RSI. Again, if you're not familiar with the RSI, one of my free giveaways is going to explain further what the RSI is. I don't have time to necessarily get into what each of these indicators mean today, given our normal time constraints. But I will touch on the RSI a little bit, show you where it's at, and let you guys make your own conclusions on what we think the market is doing in this dip. Then I look for this consolidation. So after we've seen a fall, do we stop falling? So effectively, the market is a falling knife when we're going into a bear market or big pullback. When does that falling knife find a floor? Where is it that somebody steps in and says, I've got billions of dollars and I'm ready to buy? Because me buying 100 shares here or there, that's not going to stop the market from falling. That's a blip. But when billions of dollars start coming into the market and values get low enough that real long-term investors are ready to support it, that is sticky money. They are buying and saying, if we go lower, I'm going to buy more. And if we go higher, I'm not selling. That is a huge impact for finding that bottoming process. When do they start getting aggressive and start saying, short-term bears, you're wrong, I'm ready to buy? So we look for this, at least we're not making new lows, and maybe start making some real recovery to the market, a bounce back in the market. Friday and Monday may have been an indication of some of that bounce. Today, a little bit of a pullback, but at least it's not a new low yet. And I stress yet because we have not fully confirmed this full bottoming process. One of the things that starts to confirm that for me is these positive divergences. And this is where this MACD signal comes in. It's the moving average convergence divergence. All right, I'll show you again on the charts coming up where I look for that MACD and what it looks like right now. We haven't seen many positive divergences for broad markets. We are starting to see some though, and we're getting very close in others. Once that starts happening, that's where I really start to see these trend reversals, higher highs and higher lows, moving averages getting crossed over. Again, we'll walk through that on the charts coming up. And finally, the real sign to me that the market has shown its bottom is that stocks start to break out of ranges. So growth stocks are stocks that we're generally looking to grow. Thinking tech, AI, stocks that you normally consider to be synonymous with major growth, new technology, etc. All right, so we got to look for that sort of stuff. And crypto actually tends to fit in there really well right now as another barometer of these growth stocks and where that aggression comes into the market when people are really excited for the potential for upside and willing to take some risk. We've had a lot of flight to safe havens recently. People looking for those safer stocks that just didn't get hit very much during this latest pullback. I want to see that money flow going into the riskier names, the names that can really explode to show to me that this market and this economy is strong and we're looking to invest in that potential long-term new technology. So we start with the S&P 500. First things first, I mentioned the RSI. The RSI is this chart right here. And when we get above 70, it tells me we're overbought. And when we get below 30, it's oversold. But we finally got below 30. First time in 6 months, dipped below 30. That's an oversold condition. It shows me the relative moves on up days versus down days. And when we are seeing levels below 30, it means that these down days are getting a little bit over aggressive. The seller is getting too comfortable. The bear tends to need to be fed. And when the bear is getting fed, this market has a risk of going down. Tariff news. That continuous flow of new news that seemed as a bearish input was allowing that bear to get comfortable. And frankly, a lack of news can be enough to stop them from being in their comfort zone. So we saw this extreme RSI hit below 30 a couple of times last week, and then we had a bounce back on Friday. We had a further bounce on Monday, and again, a little dip today. But overall, the RSI did bounce back from being at that extreme low. So that got me to oversold. Doesn't mean we're not going lower, but at least we got to oversold. We got to a point where maybe the bears are getting comfortable. Again, that's a starting point. The MACD is right below that with the purple and the black line. What I'm looking for is the black line to cross over the purple line. It's not there yet. That's that sign of the reversal of the trend, that the bulls are starting to get back in. We're not there yet. We did see crossing over a bunch of moving averages, and I mentioned the moving averages here. In my charts, the purple is the 10-day moving average. That's a really short-term moving average, and when we're below it, it tells me momentum is still to the downside. When we're below the red line there, that's the 200-day moving average. That's that long-term bullish flow support level. We got below it. That starts to look for a long-term bearish market here all of a sudden. That can be a big concern. So getting back above the 10-day moving average tells me there's short-term momentum to the upside. Buyers are getting more aggressive. Getting back above the 200-day moving average starts to create that comfort zone for the investor. What I don't want to be aggressive doing is buying for the long haul below the 200-day moving average, and definitely not below the 10-day moving average if I'm trying to time the market. So the purple line, it's more about market timing. That's the short-term trend. The red line, that's the long-term value being seen by the market, and that's the long-term trend. When we have a bull market, we traditionally stay above this 200-day moving average, and frankly, we tend to see the 10-day above the 20-day, above the 50-day, above the 100-day, above the 200-day. Short-term momentum even stronger than the long-term. So what we want to see is generally the inverse of what we're starting to see here, where the 10 is below the 20 in green, it's below the 50 in blue, it's now below the 100-day in yellow. Now, many of them are still above the 200-day, so we're not full-blown bear market yet, but man, it doesn't look great here. At the very least, I could go neutral for a lot of those relative levels, but in reality, it looks generally pretty bearish from the 10-day and the 200-day, and prices being below both of them. We did test the 10-day moving average in the last 2 days, but we are closed below it as of today. So short term, we're not quite there for the investor. For the short-term trader, we're not getting the signs that we're quite bullish yet. Will we make a new low below 550? Maybe. Will we go above the 10-day moving average tomorrow and show further signs of bottoming? Perhaps. Small caps have shown a little bit of relative strength after being generally much more bearish. You can see that RSI stayed below 30 for a much longer period. So we're seeing that oversold condition really since the beginning of March. So we had a couple of weeks of very low RSI. That's alarming. That's concerning. But it's also opportunity. This is a sector that has been widely ignored since the election. We broke out of the range on the election, looked like we were going to get leadership out of the small caps, generally domestic type names. Then we pulled back, made a new high in November, and then it's just been down since. A little bit of consolidation into the end of the year and the beginning of this year before ultimately starting down much, much worse. Small caps have not shown any sign of leadership. You can see the 10-day is below the 20-day, and both of those are below the 200-day. While the S&P 500, the 10-day just barely crossed the 200. That's been the case for a while now in small caps. So we're not showing any signs of recovery yet in small caps or major investment flow there. But if I look through to today, the MACD is closer to crossing over in small caps. Perhaps that lack of interest in small caps is finally coming to an end, and small caps can start to lead us out of this to a certain extent. Ultimately, I still want to see tech leadership. Tech is very comparable here to the S&P 500 in terms of being below key moving averages, seeing that 30 RSI. We are seeing a little bit of better performance in semiconductors as potentially a leading indicator for tech, but we're not seeing that investment flow into the growth stocks that I like to see for a true market bottom. So I really do need to see more action here, more buying, particularly in the tech-heavy indexes and tech-heavy names to get more and more confidence here. So what I don't want to do here is panic buy. If I'm investing, I don't want to panic sell, but I also don't want to panic buy. I'm not getting signs if I'm trying to time the market that it is yet time to go all in, full bore, buy the market, everything's okay. I'm getting some signs. Perhaps we've reached that extreme RSI, and that's enough. Perhaps we've shown signs of the bottom, Thursday's low, and maybe that's enough. But I don't have really steps 3 through 5 at all to justify a major investment flow here. I need to start seeing bigger dollars going into the market and turning some of these other indicators around. And finally, I mentioned Bitcoin. Bitcoin is a good proxy here for me for that risk appetite for the market. The RSI barely got below 30 at the end of February, kind of towed with it here a week or so ago, and did not really push above the 10-day moving average yet. So this is that consolidation period. It almost looks like it a few weeks ahead of the broad market. We had the bounce, tested above the 10-day moving average, and then a retest of the 200-day, and then a bounce, and then a little fade in the last couple of days. If I start to see Bitcoin pressing higher through the 10 and the 20-day moving average, that can be another sign of those growth sectors really getting more money flow, more risk appetite in this market. I will note that Bitcoin did not break through the 200-day moving average, and that's nice to see. That is a sign that the risk appetite is still there, just maybe a little bit more selective. It's not a buy everything market by any means. Okay. Now, with all of this in mind, I want to talk through some of the, that shouldn't say technical formation bottoming. This should say more about options here, of course. The most well-known option pricing model is Black-Scholes, and the formula has 5 inputs to calculate the value of an option. We have the underlying price, which is given by the market, the strike price, the timed expiration, the risk-free interest rate, and then finally this implied volatility element. So implied volatility is crucial in current market conditions. That is how expensive my options are. So when I want to invest in the market, there's a natural inclination to want to buy the bottom of the market. Now I can do so by just leaving a resting bid below market prices, below the lows. If I get hit, at that time, I bought the low. Doesn't mean we're not going lower, but if I do it with options, it generally happens when the VIX is near highs. So if implied volatility starts to fall, I actually can lose money even though the market bounces back. This is why it's important for me to see that bottoming process, particularly with the options, as the market starts to fall or starts to recover from that fall. So options do have risks that we need to be aware of. And I want to make sure that this is well understood here as we go into this. The options markets have options generally have higher commissions and fees than stock trades. Short options positions can be assigned, and that would convert to a stock position with greater capital requirements and a different risk profile. And that has to be factored into any decision that I'm making with a short options trade, such as a spread. Naked selling puts is often a very dangerous strategy, and I never do that for myself. cash secured puts is one thing, but just going out and naked selling a bunch of puts, I have the risk of actually putting my account into a deficit and having a major margin call. I don't want to do that. I want to continue to trade for the next day. So spreads can help that, but then they can still be assigned. What I'm looking at today is all about long options. So I want to have that lower VIX, as I mentioned, but I also want to make sure that I'm not concerned about the assignment risk that comes with that. These long options do decay in value over time, and that volatility that I mentioned is important because if implied volatility falls, my options get cheaper. And if implied volatility rises, my options get naturally more expensive. There's a lot of other risks to consider, but those are some of the key risk factors for what I'm going to cover today. So before we get back into some of that Vega conversation, I want to give you guys a baseline of why options instead of stock. All right. So a stock trade has a very simple linear payoff graph. It's a very simple straight line where if the stock goes up $1 and I'm long one share, I make $1. If I'm long 100 shares, I make $100. If I think this $100 theoretical stock here is going up 20% over the next month, then if it goes up 20%, I make $2,000. If it goes down 10% and I stop out of my trade and start over, I'm going to lose $1,000. But if we have a real catastrophe and this stock drops 20% overnight instead of 10, I can lose 20%. So even though I have a mental stop or even an order with a stop loss to exit at $90, if the stock gaps down, I'm not guaranteed of getting a fill at my price. I can lose more. I could lose everything that I put into this trade. So buying 100 shares for $100 is going to cost me 10 grand. I'm technically risking 10 grand, even if I think I'm only risking $1,000. And I have unlimited upside because just like the stock can gap down, it could technically gap up, could get taken over, could be trading $150 and I don't get to sell my stock at 120. Now I get to sell it at 150. Great for me. But the risk side of things is the biggest concern in the stop loss execution in terms of those gaps traditionally. Now with an option, I've eliminated that gap risk to the downside because a call option gives me the right but not the obligation to buy a stock at a strike price on or before a certain date, the expiration date. So if these $100 strike price calls in my theoretical world expire in 1 month and are trading for $5, it means that I have to give the market maker $5 to have the right but not the obligation to buy the stock for $100 per share anytime in the next month. And I have to pay a premium for that because I'm getting leverage and I'm defining my risk. Because one call option costs me $5 per share, and one call option represents 100 shares. So now I have control over 100 shares of stock. And if I pay $5, it means it only costs me $500 to have control over 100 shares of stock. It's a heck of a lot cheaper than buying 100 shares for $100 for 10 grand. It's 5% of the value. Now, if I want to still risk $1,000, I can now buy 2 calls and give myself control over 200 shares. To the upside, I now have greater leverage. To the downside, I still have defined risk. But there's a trade-off. I need the stock to rally just to break even. Because if we're trading $100 a month from now, I paid $5 for the right to buy the stock for $100, or I could just buy the stock for $100. That option is worth the same as if the stock had gone way down, where I just wouldn't exercise the call. I'd rather go out and buy the stock for $90 than exercise my call to buy it for $100. So I have to have an appreciation equal to the premium I paid from 100 to 105. That's where I break even. I've got greater upside though because I'm now controlling 200 shares of stock. So at a 20% return in the stock, I'm now making $4,000 minus my initial $1,000 of premium for 2 call options. Easiest to see, honestly, just with a comparison. The stock goes above 110, the 2 call options is better. If the stock gaps down to 80, the 2 call options is better. In this window between $90 and $110 a share, stock is better. So I have to have a justification for expecting major price appreciation or big risk in the stock in order to utilize the option. If I think this is a stock that's going up 5% over the next month, I don't want to buy a call option. It gives me no benefit. In fact, most likely, I'm just going to break even if I'm right. Now, if I want extreme leverage for the upside, call option all the way. If I want to find risk to the downside, call option all the way. If I just want to have a small gain, like a 2% gain in the stock, call option may not be for me. That's the benefit of looking for stocks that I think are undervalued and have significant upside. For an investment thesis, I'm looking for potentially the market to recover back to all-time highs as a way to leverage my return in the market. I don't get that. If I have to get a new all-time high just to break even, this may not be the strategy for me. But if I think the market can make those new all-time highs in the next, say, 6 or 12 months, then call options can certainly provide leverage to my returns. So I have to price in what the market is giving me, as well as what the market is pricing in terms of how big of a move we're really considering. Now, this goes back to this valuing an option. This is where I should have had it, so sorry for the early preview on it, but the underlying price is given by the market. So let's say in my theoretical stock, it's $100 a share. That's given by the market. My strike price is selected by me, but given by the market. They have various strikes available. In a $100 stock, I might be able to buy the $100 calls, the $105 calls, the $110 calls, the $90 calls. Depending upon what price I want to pay and how much price appreciation I need to get to my break even, that's what makes me choose my strike price. And how much risk I want to take to the downside and how much leverage I want. Because a $90 call gives me the right to buy it for $90 a share. That's going to be more expensive than buying a $100 call, which gives me the right to buy the stock for $100 a share. The time to expiration, chosen by me, but again, given by the market, and it goes down by a day every day. So an option expiring in 30 days, that's the expiration date. It is April 17th. That is the normal monthly option. It's got 30 days to expiration right now. It's got 29 days to expiration tomorrow. That decay starts to factor in because the less time I have, the less valuable the option is going to be. Risk-free interest rate, a minor factor when we're dealing with monthly options here with 1 month, 2 months, 3 months, even 6 months to expiration. When you start getting into long-term options, it can have an impact, or dividends can have an impact. And then finally, that implied volatility that I mentioned. When implied volatility is high, it means I need a bigger move to break even. And I can buy fewer options with the leverage that I'm trying to utilize. So if I see implied volatility rise, those calls I was talking about, instead of being $5 per contract, might be $6 a contract. Now I need 6% rally to break even. Could go to $10 a contract. Now I need a 10% rally to break even. When the market is panicking, implied volatility goes to highs. I need a bigger market rally just to get to break even. So even if I miss out on the first couple percent of the rally, I may actually be buying my call options that I want for the same price or even lower as implied volatility starts to fall. What does really volatility mean? It's that expected future movement. So it's not what's happened recently, although that is factored in. It's what's going to happen in the future as the best guess of the market and myself. That VIX index that I mentioned tells us what the current market is expecting for future S&P 500 movement. Give you a little bit of a calculator here, mental calculator. When the VIX is 16%, it means we're pricing in an expected move of 1% per day. We're pricing in an expected move of 16% per year, and it's 1% per day. So when the VIX is 24, roughly where we're at right now, it means that over the next month, every day, random behavior should move the market by 1.5%. Is that too much or too little? Given recent ranges, maybe it's a little too little. Maybe it's a little too much. We've had days where we had 2% ranges, 2% moves. We've had days with much less overnight movement, but still big intraday movement. The market looks for panic to really rise up that VIX and look for people to buy put options that give them the right to sell the stock as a way to hedge their portfolio. And when people are panicking for puts, it means they're not ready to sell their stock, but they need downside protection. When people are buying calls, it tends to mean that people are starting to get greedy, looking for an upside recovery. But when the market has bottomed and starts to recover, people tend to be less concerned about buying hedges, buying puts, and often less concerned about buying calls. They tend to start buying stock. They get that comfort zone, not worried about the 20% downward fall. And in fact, start saying, I'm going to start selling calls against my stock because if I get price appreciation, I don't mind selling my stock back to the market. I don't mind getting a sign. So when I start to see that realized volatility still high, but implied volatility falling, that can be a sign that the market is getting close to a bottom. No longer am I worried about hedging my portfolio. Maybe I'm selling out my stock and selling my hedge at the same time, getting rid of puts. So the market is selling stock, selling puts. And if the market's not going down, but the VIX is, that can also generate better leverage for the investor looking for the turnaround as opposed to the stopping of the fall. Vega is the risk that for the option that's relative to the change in implied volatility. So when we see the VIX drop by 1%, the Vega of an option on the S&P 500 is the price depreciation. So if Vega on an option is 1, when the implied volatility comes down, I lose $1. When the Vega is 2, I lose $2. You kind of get the sense here or the idea. The price of the option goes down by the Vega when the implied volatility falls by 1%. And as I mentioned, that implied volatility for the VIX, 16%. It's a 1% daily move, 16% annual move, 4.6% monthly move. 24 VIX is 1.5% daily move, 7% monthly, 24% annually. So it's giving you an idea of how much we're pricing in for that movement. If I think over the next month, the market's going to rally and it's going to rally 5%, then I think the VIX is too high right now. If I think over the next month, the market's going to rally and it's going to rally 10%, then I think the VIX is too low. Understanding my price targets and the VIX is crucial for when I'm choosing my option strike and whether or not to participate in options instead of stock. And again, when implied volatility drops, options do get cheaper due to the options Vega. So what are we seeing in the VIX? We're seeing what I was mentioning before, where the market made a low on March 13th, but the high in the VIX was made on March 10th. So on March 10th, the VIX got up to 30%, much more panic. We had a little bounce up in the market, and then a new low in the market with the VIX not making a new high. This helps give me signs from the options market that the bottom may be in. Why? Because when the VIX is going up, when the market's going down, it means people are still looking for insurance. They're buying options to insure their stock positions. When the VIX doesn't go up, when the market's falling, it tends to show a signal that the market is no longer interested. People have liquidated, they've moved to cash, and even though the market's going down, they don't need protection anymore because they've liquidated what they need to liquidate. They're comfortable with the risk they've got left. They've got cash they're looking to deploy, and maybe they're doing it by selling out of the money puts as a way to convert into stock with their cash secured put strategy. Selling a $90 put, knowing that if the stock goes below 90, I'm now long it for $90 a share instead of 100 currently. If I have the cash for it, that's a way to buy the dip. But as we start rallying away from $100, I'm no longer participating in the upside because I didn't ever buy the stock. I just said I would buy the stock on a dip. That's what we get from the skewed decks as well, which I'll touch on in a minute. But when we see the VIX doing what it's doing right now, I start to get a sign that the market panic seems to be waning. We're starting to form that floor. That's that step 1 of the bottoming process. No more new lows. No more panic in the VIX. No more fear in the market. We start shifting towards greed. I should note with the term structure of the VIX that when the market is doing what it was doing last week, we tend to see short-term VIX higher than long-term VIX because the VIX does tend to mean revert. We tend to go back towards normal where the VIX is lower, maybe closer to 18%. So it's still elevated for the long haul because we've had an increase or a decrease in the asset prices. We start to look for a greater percentage move over the long haul. But more than that, we're looking for these greater moves in the short term, the 30-day options, the 2-day options, the 1-day options, whatever, this whipsaw that we've been seeing. What we saw a month ago when the market was much quieter and at new all-time highs was the VIX was trading 15%, less than 1% per day, and the long-term options were 19%. and the midterm options were around 17 to 18%. Compare that to Friday, 21%, pretty well across the board. This is that shifting, that transitioning moment when this starts to get back to flat. When we have a very wild market, we tend to see a much bigger hockey stick type formation where the short-term options are extremely expensive. As the market calms down, cash VIX starts to fall. Long-term options still stay a little bit elevated relative to the short-term, and then they start to fall with everything going back to this inverted hockey stick. Okay? So what I'm looking at here in terms of the risk is how much can implied volatility really fall for the options that I'm selecting. First off, if I'm investing, I'm looking for longer-term options. Maybe it's 120 days, maybe it's 180 days. I want some good liquidity. I'm not as worried about short-term lack of movement. Of course, I'd like that drift higher, but I want to give myself lots of time, limited decay, and make sure I'm not taking too much Vega risk. If I think that the 120-day options from current levels can drop by 2%, and the 180-day options can drop by 1.5%, do I have an edge between the 120-day and the 180-day option? Now, the easiest way to figure that out is to look at a Vega comparison. Options expiring in about 90 days have 1 Vega. Options expiring in about 200 days have 2 Vega. So if the short-term options, these like June options, can drop by 2.5%, and those longer-term options can drop by 1.5%, is that priced appropriately in the market? Turns out the answer is kind of yes. 2.5% drop in implied volatility here equates to about a $2.75 drop in the option. 1.5% drop in the volatility here equates to a $3 drop in the option. So the real difference is that price point. If I have a $2.75 drop here in this option, that's about 10% of the value of the option decaying from implied volatility returning to normal. So about $3 on 25, it's about 10% of the value, a little bit more. Here, you got about $3 of risk on a $46 option. So about 6% of the value. So on a percentage basis, this looks a little bit better. If I'm doing it on a contract basis, this looks a little bit better. So it's all about how you're looking at it. If I want to control 100 shares of stock and the price doesn't matter in terms of the amount of money that I'm allocating, I'd rather go for a longer term, give myself more time for that stock to appreciate. If I'm looking more concerned for the number of contracts I can purchase, then the shorter term option is going to be my preference, but know that I have greater risk from the Vega if the market does drop. Or sorry, if the implied volatility does drop. I should also note here that when you look at these prices, this January 560 call that's at the money, if we go back to the previous highs, call it $612 in SPY, these are worth $52. So a 10% recovery in the market that takes the rest of this year, and I make 10% of my options. It's not very much. However, if we can get that 10% recovery in the market before the end of June, these options can double. So the speed of that move and the direction of that move matters, and the timing of that move matters when I'm selecting options. If I don't think we have a possibility of rallying 5% in the next 3 months, then I don't want to buy call options. If I don't think we're going to go up at least 10% in the next 9 months, then I don't want to buy options. If I think that we are going to go up to new all-time highs and put SPY at 650, absolutely, call options can be the answer for me. But what I really want to do is look for stocks within the market that can achieve better results than that. So I'm looking for stuff that can outperform the market in the long run. All right. With all that thought process there, the other thing that I look at in the options market for signs of a bottom is this SDEX, SKUDEX index that I mentioned. It compares the implied volatility of the at-the-money option with 30 days to expiration to the cost of an SPY put option that is exactly 1 standard deviation, so 1 4.5% move in a 16 VIX or 1.7% move in a 24% VIX with 30 days to expiration. This tells me how much this activity in the VIX is based upon people buying outright puts to hedge their portfolio. When the out of the money put options are extremely high, it means people are panicking for insurance in case of a catastrophe. When SDEX does not go up, it means the market is buying put spreads and they're pricing in a dip, not a collapse. A buyable opportunity as opposed to a real recession. So what have we seen in the SKUDEX through this fall? Throughout this market fall, SKU has not gotten bought. People are not buying puts. People are buying put spreads. They're buying at the money options. They're staying aggressive with closer to current price options and not looking for prices below, say, $500, a 20% drawdown in the market. What does that tend to tell me? Well, it tends to tell me that the fear is there with that elevated VIX, but it's not in panic mode. And it also means that the market is not positioned in case we do have a major liquidation, a 15% drop from highs, a 20% drop from highs. We're not positioned for that. So if we do start to make new lows or we do start to get fundamental inputs that cause a concern, a greater concern for a recession, the market's not prepared. I have tail risk to the downside, and I have to be prepared for that and aware of it. When I see SKUDEX go to 70 like we saw in December, that tells me that the market is getting prepared for a recession or for a situation where we have a recession and inflation and the Fed can't act. When the SKUDEX isn't going up, everybody's looking for more of a dip. You can take it one of two ways. It means that means the market is ready to buy a dip. They're just trying to time it. Or it could mean that the market's not prepared if we do really fall. I tend to see that come up when the panic really hits. And just this time, it never really did. So take that for what it's worth. It can be a little bit of a mixed bag on SKUDEX. But right now, it looks like the market is not positioned for a collapse. And they may be right. So if that market bottoms and there's no panic here, that's a good thing. People can go back to their normal hedging behavior. Now, to get into those individual stocks, as I mentioned, I look for those trend trading signals called a triple moving average signal. So I'm going to send you, as I mentioned before, my 5 indicators for trading success ebook separately tomorrow. And that'll walk you through some of the more technical trading entry signals, as well as the RSI, the MACD, moving averages, triple moving averages. And this will help in the ATR, which is the average true range. And that'll help walk you guys through how I look for risk indications and bottoming process indications for this market. And then within that, dial it down to individual names that are outperforming the market and have the greatest probability of success to the upside. Because investing in options, first step is finding that trend and then identifying the best options trade for that new trend that is forming. Now, when I actually go into the trend change, I normally look for a 3 to 5 month expiration option, June, July, August. I reevaluate the VIX terms or the implied volatility term structure for that particular stock. And then I use an in-the-money call so that I have to achieve less of a price appreciation in order to get to my break even and ultimately my leverage point in these stocks. I do use some discretion based upon where the implied volatility is. When implied volatility is low, I actually can go a little bit closer to at the money because it can have a lower price appreciation to make my profit. When implied volatility is high, I have to go further in the money to pay less extrinsic value, but it's more expensive. But once I've got that triple moving average signal, it's time to crunch down to the options and find the best way to leverage that signal with the market potentially bottoming or showing signs right now. All right, folks, if you do have any questions, feel free to throw those in the chat box or contact me, keith@optionhotline.com, phone number 312-600-8004, and keep an eye out again for support@optionhotline.com for free giveaways. Happy to discuss anything regarding the conversation from today, as well as the general market conditions. And if something comes up afterwards tonight while you're having dinner, always shoot me an email and I'm happy to discuss markets with anybody.
Hey, thank you so much, Keith. I'm going to ask you to leave this slide up just for a minute so people can write down your contact info. Everyone, please go ahead and jot this down so that you are able to reach out to Keith if you have any follow-up questions. And we have a couple of minutes available now. If anyone has questions regarding Keith's presentation that he just put on, you can go ahead and type those in the chat or the Q&A. But to your point, Keith, it does tend to be a situation where, you know, inevitably later that evening or the following day or week, someone has, oh, you know what? I just had that question. I thought of it now. So it's great to write down this email and go ahead and use it if the need arises. I am going to go ahead and take the screen back just for a moment here as we wrap up. Again, Keith, thank you very much for taking the time to put together that presentation and talk with us this afternoon. Thank you to everyone who joined us live and who took advantage of it this afternoon. I just want to reiterate, if you haven't visited our website, you can get to us by going to avantgardetrading.com. You can get to the same website by going to tradeagt.com. Visit the education tab at the top and go ahead and register for our upcoming free educational webinars right here on this page. Alternatively, you can enter your name and email, click submit on the right-hand side, and you'll go ahead and be added to the list to receive email invitations for upcoming free educational webinars. That way you don't have to monitor the website. You can just get them delivered straight to your inbox, and you'll know you'll never miss a free educational trading opportunity through Avant-Garde. Thank you again to everyone who took the time to join us today, and to those of you who are watching on the recording, thanks for doing so. If you have any questions for Avant-Garde, you can reach us at info@tradeagt.com. Keith, thank you very much. We'll definitely have you back on soon, and I hope everyone has a great rest of their evening. Good trading to all.